Here's the best 2 ETF portfolio for long-term investing. A 2 ETF portfolio contains, well, you guessed it, 2 ETFs, and the premise of the strategy is to combine 2 ETFs to have some great and reliable returns in the long run with this very easy and simple strategy that anybody could follow. As always, the first rule with a 2 ETF portfolio is to only pick one ETF for the broad market category and no more than 2 ETFs for something like the dividend, growth, or any category that isn't a broad market ETF. Rule number 2 is to choose a strategy based off of your goals, because a best ETF portfolio might not be right specifically for you. Rule number 3 is to tailor your percentage allocation based on your own risk tolerance, time horizon, and personal preference. And finally, rule number 4 is to be constantly investing and to be consistent. In this video, I'm going to go over 4 different 2 ETF portfolios with a brief background on that strategy, as well as the portfolio's pros and cons and ETFs that fit each category. So let's get started. The first 2 ETF portfolio is a broad market ETF plus small caps. For some quick background information, a broad market ETF provides you exposure to an automatically diversified portfolio because you have hundreds, if not thousands, of different companies and industries in the economy. Broad market ETFs have been around the longest with some of the most reliable returns and is usually the type of ETF that most investors have in their portfolio because it's just that good. Some great broad market ETFs are S&P 500 index funds like AVUV or SPLG, total stock market funds like VTI or SCHD, and total world funds like VT alongside many more. Now, why I'm combining a broad market ETF with something like a small cap ETF is because broad market ETFs are mostly invested into large cap companies, which means that you aren't as diversified to small caps, which can help provide more diversification given small caps can provide great performance. Some great small cap ETFs I like are AVUV, AVDV, VBK, IWM, and other great picks as well. The pros of this 2 ETF portfolio is diversification, because let's say we combine VU and AVUV, the fund overlap is 0, which is perfect for diversification. It's great for investors who have a longer time horizon or younger investors seeking capital appreciation. And you have the potential of great returns given that broad market funds have a great track record of amazing returns and small cap ETFs have outperformed the stock market a few times in history. The cons on my risk scale are a 4.5 out of 5, which is pretty high, I would say. Here's some great combinations of a broad market fund and a small cap combo that are very popular in the stock market for long-term investing. The second 2 ETF portfolio on our list is a broad market fund plus a growth ETF. Adding a growth ETF to complement a broad market fund is where things start to get interesting. A growth ETF is a type of fund that invests in companies that are expected to grow faster than the market or their industry peers. Growth ETFs have largely outperformed the S&P 500 given it is heavily weighted into technology stocks, which have been the leading sector for market outperformance. Some popular stocks in these type of funds are the Magnificent Seven of Apple, Microsoft, Google, Amazon, Nvidia, Tesla, and Meta, which have also largely crushed the market over the last decade. Some great growth ETFs I like are QQQM, SPMO, VGT, SMH, XLK, and SCHD among some other great mentions. The pros of this strategy is definitely the increased likelihood of high returns in the long run that could crush the stock market, and this combo definitely gets you rich the fastest depending on your fund allocation. The cons of this strategy is definitely low dividends because growth ETFs typically reinvest their net profits back into their underlying business instead of paying a dividend to shareholders, hence them having a low dividend. This strategy is definitely a very high risk strategy with a 5 out of 5 on my risk scale, and it's also very volatile. because the Nasdaq 100 or QQQs at one point suffered a negative 81% drawdown that required 175 months to be fully recovered given the risky nature of growth investing. Like before, here are some great combinations of a broad market and a growth ETF that are very well established and popular in the stock market for long-term growth investors. The third 2 ETF portfolio is a broad market ETF plus a dividend ETF. A dividend ETF is a type of fund that invests in a broad basket of dividend-paying stocks. Dividend ETFs also provide a great steady stream of income and potential for great capital appreciation for investors who want to one day live off of dividends. Or if you really want to, you could use this income to pay off expenses in retirement like a house, food, vacations, etc. Dividend ETFs are also lower risk compared to investing in a broad market, growth, or even small cap ETFs, since dividend stocks have high quality businesses that make a ton of money and have been around for a very long time. A few dividend ETFs I like are SCHD, DGRO, DIVB, VYM, VIG, DGRW, and so many more mentioned on this list. The pros of this strategy is for sure passive income and high dividend payments because we have a dividend ETF incorporated. Diversification is also a big bonus because let's say we combine VU and SCHD, for example, as a combo, we have a very low fund overlap of just 8%. This strategy is also lower risk compared to the other strategies we talked about so far on this video. It has a risk scale of 4 out of 5 on my own risk scale, so it is great if you do have that low risk tolerance, like I said before. The cons of this strategy is maybe less potential upside because this year, for example, growth ETFs have largely outperformed dividend funds, but past performance does not indicate future results. And know that dividend stocks will incur taxes if not in a Roth IRA or Roth 401k, so taxes is definitely a big downside. As always, here are some great combos of a broad market and dividend ETF that are great for investors looking for those sweet dividend payments and long-term capital appreciation. Our fourth 2 ETF portfolio is combining 2 ETFs together, either a traditional dividend ETF or a covered call ETF, or 2 of each if you really want to. Basically, a covered call ETF generates its high dividend income from selling call options on the stocks or securities that it owns within the fund. Some great traditional dividend funds that I like are the same one on our list prior, but some great covered call ETFs are the ones like JEPQ, JEPI, SPYI, DEVO, among some other great ones as well. The pros of this strategy is definitely the highest dividend income possible since we are only investing in dividend funds and you could get a dividend yield of around 3 to 7% plus in my opinion. It's a strategy that is the lowest on my risk scale of a 3.75 out of 5 and is best if you have a low risk tolerance. And if you want dividend income right now instead of waiting many years to see some sort of return on your investment because you have a constant flow of dividend payments hitting your investing accounts. The cons of this strategy is definitely that covered call ETFs involve higher expense ratios given that these funds constantly sell call options all the time. Covered call ETFs don't pay as consistent of a dividend payment than traditional dividend ETFs. Taxes are also a big one, of course, because nothing in this life is free. And you may or may not underperform the market depending on the market cycle and the funds that you choose. And if dividends are your thing, here are some great combos of dividend funds that are very popular and famous in the stock market for you dividend investors. Now, if you guys like this video, please give it a like because this cute puppy did. Now, right here's going to be a video on the best 1 ETF portfolio, and right here's going to be a video on the best 3 ETF portfolio, all for long-term investing in this series. Now, hopefully you guys crush in the stock market and take it easy. Peace.